Whenever we look at a company's stock, what's the first thing most of us check? The PE ratio, right? It's the go-to metric. But what if I told you that relying on just one or two numbers is kind of like trying to understand a person by only knowing their height? Today, we're going to pull back that curtain and dive into the framework that professionals use to see the entire financial story.
So, let me ask you straight up, are you investing with blind spots? It's a really important question because most of the big investment mistakes, they don't come from what we know. They come from what we just don't see.
And honestly, the gap between a typical approach and a professional one, it's absolutely staggering. Over on the left, you've got the common method. Maybe check the PE, the debt to equity, and call it a day. But on the right, that's the professional framework. Analysts are systematically screening over 44 different ratios. And this isn't about making things complicated just for fun. It's about seeing that complete picture.
Which leads us right to our first big idea, the massive danger of cherry-picking your data. When you only look at one or two metrics that, just confirm what you already want to believe, you are setting yourself up for some pretty nasty surprises down the road.
So let's start with a classic, probably the most common one, the low PE fallacy. I mean, who doesn't love a bargain, right? A low price-to-earnings ratio practically screams, hey, cheap stock, buy me now. But, well, it's very often a trap.
So here's the bottom line, and it's so critical. A low PE doesn't always mean undervalued. In fact, it can be a huge warning sign that the market fully expects that company's earnings to fall right off a cliff. It might be a value trap, not a value opportunity.
And on the flip side of that coin, you've got another classic trap, the high ROE trap. Now, ROE, or return on equity, it's a great measure of how profitable a company is. A high number looks fantastic, right? But
here's the catch. A company can juice its ROE, make it look amazing, by just taking on a mountain of debt. So yeah, it looks super profitable, but it's also become incredibly risky. All it takes is one economic downturn, and that debt could totally crush the business. This is exactly why context is everything.
So the big question is, how do we avoid these traps? Well, we start thinking with the professional's framework. It's all about having a systematic approach that gives you a holistic 360-degree view of a company's health, leaving absolutely no stone unturned.
Okay, so this professional process really breaks down into 4 logical steps. First, you gather at least 5 years of data so you can see the history. Second, you calculate a comprehensive set of ratios. Third, and this part is absolutely critical, you benchmark those numbers against the industry average. And finally, you analyze the trends over time to spot improvements, declines, and any potential red flags.
Now those 44+ ratios, they aren't just a random list thrown together. They're actually organized into 5 key categories, or what I like to call the 5 lenses of analysis. Each one gives you a totally different and essential perspective on the business.
And here they are. You've got profitability, liquidity, leverage, efficiency, and valuation. It is only, and I mean only, by looking through all 5 of these lenses together that you can really truly assess a company's quality and its risk.
Okay, first up, we've got profitability and efficiency. Think of these as answering the questions, how good is this company at turning its sales into actual hard profit? And how well does it use its assets to make those sales? Basically, is it a well-oiled machine? These numbers give you the answer.
Next up are liquidity and leverage. These two are all about financial stability. Liquidity ratios tell you if the company can pay its bills in the short term, and leverage ratios tell you about its long-term health and its debt load. To put it simply, can this business survive a storm?
And finally, only after you've looked through those other 4 lenses, after you've confirmed that the company is a high-quality, stable business, then you look at valuation. This is where our old friend the PE ratio lives, but it's alongside other crucial metrics. This last step answers the final question. Okay, it's a great company, but am I paying a fair price for it?
All right, I know this can all seem a little theoretical, so let's make it real. Let's walk through a real-world case study to see how this framework can help you uncover a hidden winner that most people would just walk right past.
So let's talk about a company called Bajaj Finance. Back in early 2020, the market was feeling pretty shaky, and this stock had a PE ratio of 35. 35! It looked incredibly expensive. If you were only using that one metric, you would have run for the hills.
But when we apply our framework, a completely different story comes to light. First, look at its profitability. Its ROE was nearly 22%. That's almost double the industry average of 12.5.
Then you check its efficiency. Its asset turnover was way higher, meaning it was generating far more revenue from its assets than its competitors. And finally, and this is so important for a lender, look at its bad loans. At just 1.6%, it was less than half the industry average. That high PE suddenly made sense. You were paying a premium price for an exceptionally high-quality business.
And the outcome? Well, for the investors who saw the complete picture, beyond that one scary PE ratio, the reward was a 310% gain over the next 3 years. That is the power of doing a comprehensive analysis.
So, what's the big takeaway from all this? It really all comes down to one thing. Seeing the complete picture is everything. A single number, whether it looks amazing or terrible, just never, ever tells the whole story. I want to leave you with this thought. Just let it sink in for a second. Every ratio skipped is a potential blind spot. It's in those blind spots that's where the biggest risks, and sometimes the biggest missed opportunities are hiding. So I'll just leave you with one final question to think about. What's the biggest blind spot in your analysis? Answering that honestly? Well, that just might be the most valuable investment you ever make.